Welcome to Yahoo Finance Live. I'm Shauna Smith alongside Brian Zazzi, and we've got a jam-packed 2 hours for you. Let's get you up to speed with an hour to go in the trading day. And we're looking at gains for the Dow, S&P, Nasdaq just barely in positive territory, essentially at the flat line, but the Dow up for the 8th day in a row. Goldman Sachs, the last of the big banks to report this morning. It's moving to the upside despite what the consensus is out there in the street for a noisy report here. And Brian, it's going to be a very jam-packed next 2 hours because we've got more earnings on deck. We're going to hear from Tesla, from Netflix, from IBM, starting to get a sense of what the tech giants, what media looks like heading into this quarter.
Sean, I'm so excited I could flip over this table, but I won't because I do not want to get canned. But I want to look at some of the tickers real quick before we get going in here. And I know my team's going to kill me for mentioning all these tickers, but hey, it's live television. Apple, really hot artificial intelligence chatter into the close here. Top ticker on our site. Carvana, this was our worst company of the year last year for Yahoo Finance. Stocks up over 30%. New debt agreement for them. Goldman Sachs, fourth trending ticker, and you brought it up before we came to air, Sean. A lot of analysts saying this was a noisy quarter for Goldman. I'll just flat out and say it just wasn't good, man. Not a good quarter from the company.
Wasn't a good quarter here for the company, but at least it looks like investors are really focusing on maybe some of the comments that we heard from Solomon in that earnings call, saying that the last 6 to 8 weeks he has seen some improvement there, and that, of course, could be good news here for the bank going forward. But when it comes to Tesla, one of these reports that we're going to be focusing on after the bell, a lot of this is going to come down to margins and the pressure that we are seeing there. We know Tesla has cut the prices of their vehicles several times since the start of the year. What exactly, how much pressure that's putting on their business, at least for now, as they try to improve that demand picture. We'll get a little bit more about that from us.
Only reason I'm listening to this Tesla call, Sean, is to see when the Twitter IPO is. No, definitely, just kidding. No, but really, gross margins, big focus item.
You know, we've got you covered all aspects. You never know what's going to happen on that call. All right. The IPO market, though, is slowly coming back to life as deal-making activity collapsed last year. More companies are tapping the public market. 63 firms making their debut since the start of January. Oddity, the beauty and wellness tech company, is the latest firm to go public, listing on the Nasdaq today. They listed under the ticker ODD, and shares jumping in their first day of trading, up just about 36%. Let's head over to Julie Hyman at the Nasdaq. She's standing by with Oddity Tech Global CFO Lindsay Drucker-Mann. Julie.
Thank you so much, Shauna. And yeah, Oddity, better known probably by many of its brands like Il Maquillage and Spoiled Child, and it uses AI to try to discover new brands and new opportunities. Lindsay, thanks so much for joining me to talk about this. I know it has been a long and exciting day.
Very exciting.
I want to start with a little bit of a personal question because I'm fascinated by your journey here. You were at Goldman Sachs for many years.
Yes.
You were in the capital markets business there. So on the other side, helping many companies go public, raise money, et cetera.
Yeah.
What convinced you that this was the opportunity to jump for?
That's a great question because I wasn't looking to leave my job. I was at the height of a career that I really loved. I've always loved stocks, maybe similar to you, markets. I loved where I worked. But when I met our co-founder and CEO, Ron Holtzman, and I saw the financial profile of his business, I knew immediately I had never seen anything like it before. And this is in the midst of, many other direct-to-consumer companies that had struggled, that were already reversing, and where a common theme from them was that the unit economics just don't work. Maybe the internet's a lot smaller than we think it is, and there's real saturation. But when I saw what his team had built with very little capital raised to do it, and in such a short period of time, I had never seen anything scale as rapidly or as profitably. And then spending a little more time, I was blown away with how hard and fast the team was running. I mean, the global beauty and wellness market is huge. I've always thought it was a super high quality place. I mean, you've got amazing businesses that always traded at great multiples that investors really loved, that dominated that category. But to find something with a technology engine strapped to it that was disrupting it, and how quickly the team was running at those opportunities really blew me away. So while it was a hard decision, I wasn't planning on leaving it. Ultimately, it was a no-brainer.
Yeah, so as I was looking at the financials of the company, we should mention you're profitable, which is obviously somewhat unusual for an IPO. The margins are also fairly comparable with the large, more mature beauty and wellness brands that are out there. Talk to me about the business model a little bit, because I know you do a lot of investing in technology in particular to develop new products.
Yes. So we're unlocking online for one of what we believe is one of the most attractive and lucrative TAMs on the planet. It's this big, massive global beauty and wellness market. So many attractive categories, so many attractive demand pools, but had really been behind the curve in online adoption and really in technology investment. And that was the opportunity that our founders saw. They invested early and aggressively into transformational technology like AI, like computer vision, and by harnessing the power of those technology tools and the data from our users, they were really able to tap into a model that unlocked online for the first time. And whereas I think incumbents were under the impression that the underpenetration of online in the category was a function of the consumer not wanting it and the consumer preferring a store, ultimately what we have been able to prove out is that it's not that she doesn't want it, it's that she never had the ability, the means, the platform that would enable online adoption. And now that we've actually put this out there, the pent-up demand from consumers, the speed at which they're adopting our products, our platform, the speed at which Il Makiage has grown, the speed at which Spoiled Child has grown, even though it's just about a year old, a little over a year old, incredible pace of growth, shows you that it was really more of an enabling obstacle rather than a desire. And so for us, because we've tapped into that, we're able to grow in a way that's very rapid, at the same time quite profitable. You mentioned our margins, also our cash generation. We converted well over 160% of our earnings into free cash flow last year. We exited the second quarter with over $100 million of cash on our balance sheet. That's cash that we made through earnings, not raised externally. And so it's been a really powerful model as a result.
So speaking about the online penetration, you guys said in your prospectus you're looking at beauty overall as an industry to be 50% online in the near term, if I was reading that correctly. That's higher than anything else I've seen for estimates. McKinsey, for example, puts it at 26% of the total market by 2027. What is it that bridge that gap for me?
Yeah, I mean,
why
look,
do you all think it's going to be?
We're still clearly early in the curve of online adoption. But if you look at other international markets, for example, in China, you can see the penetration rates are so much higher and actually approaching that 50% level already. Now, with the advent of our type of model and other models that may develop in the future where you're using further technology enablement, so in our case, AI and computer vision, you're just breaking down all the barriers, all the frictional elements that would keep somebody from transacting online. You're actually breaking down those barriers, and so the pace of online adoption could be much more significant than what some of those preliminary estimates were. I think the final thing I will say is that the speed at which we're seeing people come to our sites, that we're seeing them come into our brands, is a really strong reflection of that pent-up demand that gives us optimism of that adoption in the future.
So now that you're public,
yes.
Where is the focus going to be? Is it going to be on expanding the number of products that Il Makiage and Spoiled Child offer? Is it going to be launching new brands entirely? Where are you going to be putting your attention?
Well, look, for a business like ours that is competing in what we believe is the most attractive channel for online of an expansive global market, one of our key areas to get right is prioritization, because there's so many different ways to grow. For us, number one, we've talked about the opportunity set in our existing portfolio of brands, whether it's Il Makiage, Spoiled Child, even just growing the core of what they have today. But on top of that, new product categories, new markets that we know we can expand into. We've made great strides in computer vision that we're rolling out into Il Makiage, for example. So that's one key area.
That helps, sort of diagnose or tell people what look good on them.
So one of the key reasons why the category has been underpenetrated online is that the consumer needs help. She doesn't know what she wants. She doesn't know what she needs. She walks into a Sephora, she walks into a beauty store. There's so many things that she can choose, different shades, tones, undertones, skin conditions. There's a salesperson, a sales associate there to help her. There's a sales associate there to show her how to use it. That doesn't happen online when you're just dropped into a website catalog. So one of our core innovations, product matching, recommendation engines, and then helping the user understand exactly how to use the product to make it right for them. And so up to this point, we've built that with products like Power Match. Maybe you've seen that as one of our big consumer-facing AI engines, and shade recommendation. Power Match, which will deliver the perfect shade for you, as an example, We've done that based on data and AI alone. We're now rolling out those vision capabilities to unlock even better matching than what we have today. And so I think that's one, as you talk, just going back to the question, where's our priorities for growth? There is so much more that we can do in the core. But on top of that, we're building many, many more engines for the future. So I talked to you not that long ago about Oddity Labs and what we're building using AI-based molecule discovery to find the next generation of science-backed, high-performing products to solve consumer pain points. We've got new brands that we will bolt on to our existing platform. We know those brands are satisfying very real needs that users have because they tell us. We've got skin conditions, we've got acne, we've got other concerns. So brands 3 and brands 4 that are independent teams but use our shared technology stack and our shared information that we know about our users to deliver great outcomes.
Gotcha. Lindsay, thank you so much.
Thanks
and
so
congrats on the IPO. Lindsay Druckerman is CFO of Oddity. Thanks again.
Thank you. Thanks for having me.
Shauna, back to you.
All right, Julie, thanks so much for bringing us that conversation. Of course, our thanks to Lindsay Druckerman as well.
All right, Goldman Sachs rounding out second quarter earnings season from the big banks, and, well, it wasn't pretty. Profits tanked 58%, hit by write-downs in the company's consumer and asset management businesses. Embattled CEO David Solomon told investors on the conference call he is confident in his strategy, but should investors be confident in David Solomon? Mike Mayo is Wells Fargo's managing director and head of U.S. large cap bank research. Mike, always great to get some time with you, especially in studio. So David Solomon saying things might be okay, things might be getting better. Should investors believe him?
Well, let's do the short term, medium term, and long term. The short term is this is a situation of sell on the rumor and buy on the news. We had been expecting in our numbers big write-downs. You got big write-downs, and you, as a firm, can't have $1.1 billion write-downs every quarter as you pivot away from consumer, as you pivot away from an acquisition they did, Green Sky, as they pivot away from all these on-balance sheet investments. And by the way, a lot of write-downs for office specifically. So that's what's happening now. So the bad news is out there and the stock's up today. In fact, I actually increased my estimates because you got some of the bad stuff out. In the medium term, it waits to be seen how soon the capital markets come back. You've had lower for longer investment banking. You've had less volatility for trading. So in some ways, it's the worst of all worlds, but the backlog is up at Goldman Sachs versus last quarter. And the question is how much of that backlog do you convert and monetize to revenues? But the long term is what's really the big question here is. And Goldman Sachs is going back to the future by getting out of consumer, which I thought was stupid day one. You go back, any research, anytime I've been on your show, why were they going?
Nobody's using a Goldman Sachs credit card. I mean, this is Amex. This is Amex land, MasterCard, Visa.
I don't even mean that. I mean like the market's lending. You're going to lead off to the mass consumer in the United States with a lending product. Sure, that doesn't create sticky relationships. And then they go ahead and do that with a savings account by charging. That doesn't create sticky relationships. By the way, look at JP Morgan in London. They lead with a checking account where you interact several times a day. That builds sticky relationships. So I thought it was stupid, and the more it went on, it was even more ridiculous. So better late than never to pivot away from this. But now they're going back to the future. Their legacy over the past 150 years has been serving large institutions. So 2/3 of the company is global banking and markets, where they get mid-teens returns. They have number one leadership in mergers for 20 years. This quarter, equities did great. So that part of the business, nobody has too much question about. Another 1/3 of the company is wealth and asset management. They are doing better in the wealth business, but they have to get rid of some of these principal investments, which is a big drag from a regulatory perspective. And then there are extracurricular activities in consumer and some of these other things that they're getting rid of. So they get rid of the stuff that's extracurricular. They stay in their lane. They pivot and make themselves more balance sheet efficient and more operationally efficient. And then if and when these green shoots materialize, maybe they get from a lowly core, the ROE this quarter was 4%. This was the second worst quarter under David Solomon. Excluding the pandemic, it was the worst quarter in over 7 years for Goldman Sachs. So this is bad. You can't keep doing this. But their goal is to take it from the 4% or 9% adjusted for the charges, up to 15% over the next 2 to 3 years. I don't have that. No one in consensus seems to have that. So no one's really believing David Solomon. So the bar is low. they're not trading too far above book value for a company that's grown book value faster than most banks. So I think this is an opportunity. The risk is that it just stays kind of dead money as other things go up. But this is a big pivot. This is a big day for Goldman Sachs. David Solomon is under pressure. So I think over the next year, we're going to have to see, some signs that they're going toward that 15% return.
Mike, do you think Solomon is the right person for this job? Is he going to be able to steer Goldman in the right direction? Because there has been, like you just said, tremendous amount of pressure, not only from shareholders, but even within the firm, from partners who haven't been happy with the direction.
Well, look, like anyone else at Goldman Sachs, David Solomon has to earn the right to be in his job every day. I think from a strategic standpoint, this idea of focusing on two core businesses, pivoting out of the stuff that isn't so core, is the right strategy. So really it just comes down to execution, and can they execute on their plans? And that's why I'm here, that's why you're there, that's why all the eyes are there watching them quarter to quarter to quarter. So right now, David Solomon is still there. He's actually, the stock price has outperformed since he's been there. Their capital markets activity has grown much faster than the others since he's been there. They've created book value faster. So on those metrics, it looks good. But I'm more concerned about the next 3 to 5 years. So yes, David Solomon is the right person at the moment, but I'm still watching closely quarter by quarter by quarter.
Mike, I've followed your work probably for well over a decade, and there's been a theme during that decade. The leaders that are still operating this business, leading these companies as CEO, are still entrenched. Brian Moynihan, I talked to him yesterday, very much engaged. Doesn't sound like he's going anywhere anytime soon. Maybe Jamie Dimon finally bows out as CEO in the next 2 to 3 years. He's been teasing it for 10 years or whatever it is. Morgan Stanley seeing a change in James Gorman in a year and a half. What has this current guard of CEOs meant to the financial services industry? And is the next crop of leaders, are they as good as these guys?
Well, these leaders were born out of the global financial crisis, which, as you recall, from 2008, 2009, was the biggest crisis since the Great Depression. And so they learned some pretty hard lessons. And so, these are survivors from that crisis. And so it doesn't kill you, makes you stronger. And that's certainly the case with Jamie Dimon, which bought Bear and WAMU during the global financial crisis. And then he comes back again and buys First Republic and acts as a leader. So, look, I've had my spats with Jamie Dimon, and I just thought they were spending way too much a year and a half ago. Now they're showing incredible discipline. I mean, what company? I mean, you had an IPO on just now about beauty right before oddity. I thought banks might be that's the beauty. Banks are the beast, I guess. So today you have Beauty and the Beast. But I mean, what company? JP Morgan just guided for $10 billion higher in revenues between this quarter and last quarter, and guided for 0 increase in expenses. That's amazing after all the criticism I gave Jamie Dimon. So you're not going to find too many Jamie Dimons coming along. In terms of James Gorman, I said in 2012, I upgraded the stock. I said either the stock price should go higher or he should be fired. And after that, James Gorman, it was an intraday upgrade after they had a terrible fixed income quarter. James Gorman picks up the phone, calls me. I thought it was a joke at first. And the first reaction by him, and he had his team, I had my team, he said, so that wasn't very nice. And I said, well, I just think the stock should go higher. He goes, so do I, and let me tell you why I think it will. So this idea of not acting defensive, you get red flags when people act defensive. You see it on your show sometimes. But this was the opposite of acting defensive, being open-minded. So I think that sort of open-mindedness, you can have that, you might not have that, but when someone gets in the position, do they actually act that way? And Brian Moynihan, I also thought he should be fired. I went to a special shareholder meeting a decade ago, and he proved me wrong. And frankly, I think I would have said the same thing a decade ago. I'm not sure he was ready to become CEO, but that just grinded out quarter after quarter, year after year, build a better mousetrap. So I think they're all good in different ways. So there's definitely an opening for new leaders to emerge, but they won't have been as battle tested as James Gorman, Brian Moynihan, or Jamie Dimon.
Point well taken. Mike Mayo, thanks for coming down on a very busy day for earnings. I know you have more to go. We appreciate it. It's a real treat.
Thanks for having me.
Thanks so much.
All right, well, let's do a check of the markets here, sponsored by Tasty Trade. About 40 minutes to go in the trading day. You're still looking at gains across the board. The Nasdaq barely hanging on a positive territory. The Dow up 158 points, a stronger start to the earnings season led by the bigger banks. That's helping investor sentiment here on the street. And flipping over to the VIX, the fear gauge index, taking a look at where that is trading as we close out the trading day, up just about 2%, 1358. All right, we're just getting started here on Yahoo Finance Live. Coming up, we are 1 week away from the next FOMC meeting, and a 25 basis point hike seems like a sure bet at this point. What this means for investors, for the markets, for the economy, we've got that coming for you next. Plus, actors go on strike after talks with major studios collapse. We're going to speak with actor Sean Gunn later this hour. And it certainly is a busy day for earnings. Netflix, Tesla, IBM, and United all set to report after the bell. We're going to bring you those numbers as soon as they cross. We'll be right back.
Recession fears still lurk on Wall Street, despite the economy continuing to chug along. Bank of America CEO Brian Moynihan told me this week his people see a minor recession in early 2024. So should that be the case for exuberant investors bidding up shares of Apple, Microsoft, and other tech kings like, of course, NVIDIA? The ever so bullish Ryan Dietrich of the Carson Group is here with us. Ryan, good to see you as always. So are you still bullish on this market, despite the market really trading up quite high over the past few months and now trading at valuations that some would say are not exactly justified by the earnings we're seeing this quarter?
Me a Yahoo. Thank you. But yes, we came into the good. That was a
Ryan, it looks like we're having a little bit of trouble with your audio, so we're going to take a quick break. We're going to try to get that sorted out. We'll be right back.
Recession fears are still swirling on Wall Street, and should investors, well, should they care? The ever-bullish Ryan Dietrich of the Carson Group is still here with us. Ryan, do you think the market has moved too fast, too quickly, given what we are seeing this earnings season? We're seeing beats, but earnings right now are still tracking down year over year.
Yeah, Brian, thanks for having me back. And you did send me a Yahoo Finance hat a while back. Thank you. I should have wore it, actually, looking back. But
next time, my friend.
We came into this year pretty bullish, right? We said with any good news, maybe hit new all-time highs. Wasn't very popular when we said that, but now here we are. But I'll tell you, I want to focus on just today, right? Look what JB Hunt said. The headlines weren't all that great. The stock's up 3%. Are people listening to the message of the market? Yes, things are a little frothy. Tech's had an incredible run. We just, Brian, a week ago released our mid-year outlook. We said, hey, things are going to broaden out. It's not all tech communications. We've been seeing that theme just today. I know you had Mike Mayo talk about banks right before me here. You know, banks are breaking out, right, to multi-month highs. Regional banks are breaking out. This bull market, I think it's the baton is being passed around. It's not just tech communications. Maybe they need a little bit of a break in those areas, but other areas are taking over. Our two favorite areas the rest of this year, industrials and energy. We think those two names are going to do pretty darn good, and we just still do not see a recession.
Ryan, what does that upside look like if you're taking a chance in industrials, in energy? How much opportunity is there to run?
Yeah, I mean, well, put it this way. Our target on the S&P 500, we think for the year can gain between 21 to 25%, which has put us right around there. But on, energy names, let's talk about energy for a second. I mean, crude oil feels like it's been flirting with 70, up 75, trying to bottom. Natural gas has been trying to bottom. But some of the, like XOP, some of the real aggressive energy names have been doing really well. So could there be well over double-digit returns the rest of this year, maybe even higher? We think absolutely on energy. Now, again, don't make a wild-sized bet here. But again, energy looks good. Industrials are the most like the market. The highest R squared means it goes with the market. So overall, if industrials keep doing well, we think this earnings season, industrials and energy both could do well. Final comment, and you've had guests talk about this, the dollar weakening, 15-month lows. We said the start of the year, a weak dollar could be more of a tailwind for better earnings second half of this year. We think that's happening. And as most of us know, a weak dollar tends to help commodities. So we think it probably isn't going to hurt, at least, energy and industrials are really cyclicals in general here.
Ryan, real quick, we're getting some community feedback. You should have wore your hat next time, just a reminder. But look, to the extent you could explain this for us, what do you do if you own shares of NVIDIA, Meta, Tesla, some of these tech stocks that are up triple digits year to date? What do you do with these names ahead of their earnings reports? Do you buy more, or is it now the time, really a good time to take profits?
Yeah, let me be clear. I can't give individual equity advice, but let's talk broadly here. I mean, yeah, I think it doesn't hurt to ring the cash register a little bit in some of those names. I mean, we just talked about some other beaten up names, but potentially some of these moves are truly historic. I mean, the stretch, the Nasdaq is historically high above its 200-day moving average. Not the end of the world, believe me, but maybe a little pullback perfectly fine. That bar is very high for some of those names we just talked about this upcoming earnings season. But again, we think industrials, some of their other areas will do a little better this upcoming earnings season.
Ryan, let's talk about the Fed, because it's widely expected that we're going to see another rate hike next week, this time 25 basis points. Are you in that camp in terms of should the Fed raise rates again? And if they do, what does that mean for the markets?
Yeah, I guess we'd be in the camp they don't need to. I don't know why. We look at all the inflation data coming in. Shelter makes up 41% of core CPI, drastically going to start coming down the second half of this year. But I'm not in charge of the Fed. The Fed is going to hike rates 25 more basis points because they really want to stamp out inflation, because wage growth's been a little higher. We get that. But we do think this is it, right? And what does it mean for the listeners, the investors out there? When I took a look, the last 10 times the Fed paused after aggressive hiking, 1 year later, the S&P was higher 8 times. Yes, the early 80s is in there. Yes, early 2000s. So this isn't perfect. A lot of other things to consider. But we think, inflation's coming back. The Fed is likely done hiking. The economy led by a strong consumer, housing, manufacturing, both showing signs of bottoming. It's been an incredible run for investors this year. We get it. August, September, hey, maybe you get some of that seasonal volatility. But I'll tell you guys, from where we are right now to the end of the year, we think there's clearly opportunity for more upside here.
And Ryan, one of the things that has been helping the markets and looks like it might continue to help the markets is the resilient labor market. And we know that's something that the Fed is also closely watching. What do you see the jobs picture looking like at year end? Do we need to see, or do you think we will see any more weakness there?
Yeah, I mean, we've made, I think it's 1.67 million jobs this year on the heels of 5 million, a record 5 million last year. So clearly the employment backdrop is extremely strong. And yes, it's coming down. Maybe we start to make about 100 to 150,000 jobs per month. That's not the end of the world. You need about 100,000 jobs to keep things going. So if and until we see major weakness there, which we don't anticipate, I want to be very clear, that things can keep chugging. I mean, let's be honest. We want to get back to normal. It's one of our themes in our mid-year outlook, edging closer to normal. We don't want to be making 400,000 jobs every month. Between 100 to 200 is perfectly normal. And I think most of us could take some normal after what we've gone through the last several years.
Ryan, as part of your, I guess, upbeat outlook for this year and maybe into early next year, is it reflect a view that consumer prices continue to decelerate? That was the vibe coming off of last week's CPI. But folks we have talked to are suggesting we might see a reacceleration in inflation into the back half of the year. I mean, do you see a reacceleration? And if we do get it, does that blow up this trade?
Yeah, we don't think there's going to be a reacceleration. I mean, CPI headline 3%. We understand that. Energy down 17% year over year. That's a big part of it. But I kind of hinted at earlier question. Shelter's been that stubborn part, right? You look at rents like an Apartment List and Zillow, they have come crashing down. Our friends in the government, for whatever reason, it takes a while for the government data to start to show that. Just last month, Brian, we started to see that. So to us, that's a big part that's going to be kind of a tailwind, if you will, for better inflation data the second half of this year with shelter. Maybe some other parts go up, but hey, shelter is that part that hasn't participated yet. We think it's still going to put a lid on things, and that's the market's going to like that. Real quickly, when you look at years when inflation's simply lower than it was the year before, the S&P does like twice as well as it does if inflation's higher. Not overly surprising, but this year inflation's coming back, and it's one of the reasons, along with the economy that surprised everybody, that stocks are doing so well this year.
So Ryan, you certainly do see upside potential here for equities moving forward. What about the bond market? Is there a place, and what is that allocation? What should that allocation look like within investors' portfolios?
Yeah, we came into this year underweight fixed income, overweight stocks, equities. We're still there, right? We say shorten up duration a little bit. Yes, the Fed is probably going to be done hiking soon, but they're going to be higher for longer, like we all keep talking about. And again, it just means maybe avoid some longer term bonds. There's always a place for fixed income in a portfolio, but let's just hypothetically say someone has a 60-40 portfolio. We maybe say, 35, 36% or so maybe in fixed income. We actually like gold a little bit. We've got some gold, a small sliver of gold in some of our tactical portfolios that we run for our Carson partners. We think gold might be a place that maybe does a little bit better than bonds actually second half of this year.
All right, we will keep track of that trade. Ryan Dietrich, always great to have you. Look forward to talking to you again soon. Ryan Dietrich of the Carson Group.
All right, top ticker alert. Shares of Apple hired today on a report that the tech giant is working on its own AI chatbot to rival ChatGPT. Yahoo Finance's tech editor Dan Halley is here with more. Dan, so is Apple, I guess, the new NVIDIA tech play here? Is that serious on what they're working on?
It's hard to tell, right? So this is from Mark Gurman, who, again, lives underneath Tim Cook's mattress or in his walls. I don't know what he's done, but he's doing it. And this is basically a kind of technology called Ajax. And this is basically what he says is the foundation of an AI software. So it's not necessarily that they have a ChatGPT rival going, though the report says that they are building one or are working on one internally. There's questions about how this would even work for a company like Apple. They don't have a search engine that this would fit into nicely. They have Siri, but Siri's just kind of been hanging out there, not doing a whole heck of a lot, or even that good. So I don't know what this would slot into. And the other thing to take into account with something like this, and I know, obviously investors are excited about it, not to throw cold water on it, but because of the kind of languishing that Siri has done and the fact that they don't have something where this really kind of fits in, you would think that this technology would slot in silently behind the scenes to power some of its other software, right? And that's a very Apple move. They wouldn't say, and I'd written this a few months back where if you listen to last earnings season, every company seemingly on their earnings call was just AI. It was like at 30-something times that Microsoft mentioned it, 20-something times Meta, 30-something times with Alphabet. I forget the exact numbers, but Apple mentioned it twice. And that's only because someone asked a question of it. So the big thing for Apple is, and I know this is kind of like, leading into their favorite words, magical and whatever. But they really do like to put the technology behind the scenes so that you're just working with the product. And so I don't think that despite them working on this, we're going to get a huge, this is our AI play. They're going to have a product that this works with and will likely work well outside of Apple Maps when it first launched, although supposedly very good now. I do think, though, it's going to be something that's more of a backseat driver than something where you can go, they're in AI, yeah, and get all pumped. So don't expect ChatGPT or Apple GPT, as this piece refers to it as.
Yeah, we'll see. You got to think that at least one analyst is going to ask about maybe this report specifically or what those ambitions do look like for AI. Dan, when it comes to earnings season overall, there's high expectations heading into the big tech earnings, right? You were just talking about the massive rally that we've seen in a lot of these AI-related names. Are they going to live up to that hype?
So that's the big question, right? I mean, everybody's just been nonstop AI. It was the first half of the year was just AI. Now is where it's going to have to pay off. And, we saw a kind of glimpse of that with Microsoft yesterday when they announced pricing for Microsoft 365 Copilot. That's one of their AI initiatives that they're offering, $30 per user per month. That's a spicy meatball, as I guess my Italian wife would say. There it is. I'm not Italian, so we'll just say my wife says it. Anyway, that's something that they're going to end up rolling out more and more of. And you saw Microsoft's shares jump on that. Not so much today, kind of giving up those gains from yesterday. But we're going to have to hear more about how Google is using this technology. We saw a lot about it at I.O. Their search engine piece, that's still a experiment that they refer to it as. Bard still kind of being worked on, and Google's history is always everything's consistently in beta for 20 years until it's finally ready for prime time. So we'll have to see how that works out. They do have generative AI in Workspaces, which is their enterprise product, but Microsoft is clearly the one pushing it here. Meta, they're still putting together their team. If they have put it together already, it's something they're going to continue to work on. I think the big thing, and we have it there, is the PC market turnaround in chips. And we saw ASML talking about how they're getting more orders out of China. The other companies, Samsung and the like, TSMC, not so much because they're still building out their factories in the US and Europe. But I think overall, the PC market is supposed to start picking up again. Might get back to growth in 2024, though. So for Intel, for AMD, for NVIDIA on the PC side, maybe not so great. For NVIDIA, though, they said that they were going to have that huge blowout quarter. That kind of sent this whole AI rally into overdrive. So we'll see if they deliver.
Dan, I'm trying to figure out why your Apple Watch looks better than mine. It's actually making me upset. Is it the black red rim around it?
It might be. It might just be.
Rim.
It might just be that it's on a work of art already.
Oh wow, that's live television.
Yeah.
Dan Al, you're the man. We'll talk to you soon.
SAG-AFTRA, the union representing 160,000 actors, singers, stunt performers, and other media professionals, is on strike after talks with major studios and streamers collapsed. Now, the dispute is with the Alliance of Motion Picture and Television Producers, which bargains on behalf of studios like Disney, Netflix, and Amazon. The key issues at stake: higher pay, residuals, and the use of AI. We're joined now by one actor who's pushing for big changes in the industry, Sean Gunn. You may recognize him from his roles on the hit TV show Gilmore Girls, also from Guardians of the Galaxy movie franchise. Sean, it's great to have you. Thanks so much for taking the time to join us here this afternoon. A major issue.
Oh, thank you.
A major issue for you, Sean, with these talks, with the strike that's happening right now, is residuals and how little actors are paid, especially when shows are streamed. We're going to hear from Netflix. They're reporting earnings next hour. It's expected to be a very solid report. I'm curious, what's your message to streamers out there, given the fact that you're pushing for significant more pay?
Well, I mean, part of the problem is that we're operating off of the old system. So it used to be very equitable for actors to participate in the profit sharing when there was shows that are in syndication and all these kinds of things. Well, the streamers came along and they changed the whole model of how business is done, but they continue operating off the old model. So now we don't share at all in the success of the of any of the shows that Netflix has. They want to keep their numbers secret and keep them private. And they do that so that they can screw us over and make sure that we don't get to participate when things are going well. And that just absolutely has to change. It's not fair. We should all participate when there's success.
Sean, what is a fair structure?
Well, first of all, I want to be clear that I'm not a member of the negotiating committee. I'm not a member of the SAG board. So I'm only talking on behalf of myself as a SAG member, which I've been for over 25 years. But honestly, I'm a big fan of the NBA, and I feel like the NBA has struck a pretty good chord between labor and management because they're transparent. We get to see their numbers. They have. We know how much profit they're making, and then they split up those profits equitably amongst everybody who's participating. So, yeah, I think a fair deal is percentages. We're not asking for a flat sum. We want a percentage. That's fair, because then when they cry, oh, our profits are down, we're not making as much. Okay, well, we'll participate in that too. We just want an appropriate portion of the profits that you're making.
And Sean, studios have pushed back, saying that the SAG-AFTRA union has dismissed their offers of historic pay, residual increases. We also heard from Disney CEO Bob Iger during an interview last week, and he was calling some of the demands from your side unrealistic. What's your response?
I think it's a shame. I'm using Bob's words there. It's a shame that the WGA put numbers out and found that what they're asking for from Disney, and I again, I'm a SAG member, not a WGA member, but we stand together. I think we're all together on this fight. What the WGA is asking for from Disney is $75 million a year. That's how much it would cost them if they gave in to every last demand that the WGA has. Well, Bob Iger makes something like $50 million a year. Why is this okay? Why can't we shave some of those earnings off of the top people? I mean, the problem is that shareholders have decided that if we can squeeze every last dollar we can out of labor, then our profits will go up. But that's not right. It's not ethical. It's not equitable for anybody, and it's not fair.
How big of a pay cut, Sean, would you like to see from a Bob Iger? I mean, this guy's made hundreds of millions of dollars for many years over at Disney. I mean, he doesn't appear to be listening to anyone's concerns.
Look, Bob deserves to be rich. He's made his money out there doing his thing. But what he doesn't deserve is to shake his head and say, it's a shame for the people who are down at the bottom of the company that I work for. That, like, it's okay. I'm gonna get a few extra dollars of profit from the laborers, and then we'll fill our own coffers with that. That's just not fair. I mean, I think that in 1980, the average CEO in Bob's position made something like 30 times what the lowest worker for his company made. Now Bob makes 400 times. Like, come on, it's not fair. Let's all participate.
Sean, the other concern we haven't even talked about yet deals with AI and the impact that could potentially have on the entertainment industry. What are your biggest concerns when it comes to artificial intelligence and how that can really change the landscape for entertainment?
Well, let me be clear about one thing, which is that they've asked for, the AMPTP has asked for the right to scan an actor and own their likeness, own their image in perpetuity. I think anybody, you don't have to be an industry insider. I think anybody can look at that and say, that's not right. We can't just let people just own our likeness forever. That's absurd. We shouldn't do that. I do know that AI is it's changing. It's changing a little bit every year, and I don't know what the industry is doing on this, but I think that what would be most fair, because what we're looking for is fairness. What would be most fair is if we have, a third party take a look every year at AI and say, let's look at how AI is changing the industry and make sure we implement that equally so that everybody's participating in its use. It's going to it will certainly help some facets of the industry. It'll hurt others, but let's make sure we take a look at this every year and see where it is.
Sean Gunn, we know it's a busy time for you and a very important time for you and your colleagues in the industry. Thanks for making time for Yahoo Finance. We appreciate it.
I appreciate it. Thanks for giving me some time.
Of course. All right, coming up, we are inching closer to market-moving earnings reports from Tesla, Netflix, and IBM after the close. But before all that lights up your screen, our Jared Blickery has a market guide next.
Warner Brothers' Barbie has fans buzzing, but it's much more than just a movie to Mattel. The company is betting big on Hollywood, with several movies based on its toys already announced. Here are some of the top films in the works. Polly Pocket. Lena Dunham is planning to write and direct, while Lily Collins is set to star as the famous Micro Doll. Hot Wheels. J.J. Abrams' company Bad Robot will reportedly produce the film based on Mattel's toy car brand. Thomas the Tank Engine. Set to be directed by Quantum of Solace director Mark Forster, the movie will be a mix of live action and animation. Rock'em Sock'em Robots. Vin Diesel is set to star in a live-action movie based on Mattel's two-player action toy. And Viewmaster. MGM and Mattel are reportedly teaming up to produce a live-action movie about the stereoscope toy. If Barbie or any of the Mattel films want to be the queen of the box office, they'll have to take down Hasbro's Transformers, the highest-grossing movie series based on a toy franchise. The Dow on track for its 8th straight day of gains. Jared Blickery is here with a closer look at, even though we're looking at that for the Dow, he says that you should be watching the S&P and the VIX. What do you got?
I'll tell you what, I have noticed something here with the help of Twitter that's pretty interesting. Here we clearly have another rally underway, although the results aren't that big for today. But I want to show you what happens with the VIX. This chart goes all the way back to 1990. That's the inception of calculations for it. This is the VIX down here, and you can see it's mean reverting, although it does spike up pretty high sometimes. And here we have the S&P 500, and these pink dots are when the VIX is actually below 14. And so you can see this tends to kick off long-term bull stretches in the S&P 500. Here's one that begins in 1992, and then we have another one in 2004 before the global financial crisis. And then in 2012, we have another one. This is actually kind of a series. 2012, we've got some interruptions here, the bear market of 2015. We got the Powell bear market of late 2018. And also, we got the pandemic. But what you'll notice here is that we haven't had any pink dots before June of this year until before the pandemic. So is this a new era of bullishness? Well, I think it's safe to say we've seen a lot of that unfold already. This VIX, the low VIX, can persist for long periods of time. However, I'm going to caution this with a look at the bond market. Now, we have the VIX for equities, but in the bond market, we have the MOVE index. Let me just convert this to a line chart. You can see the current reading is among the lowest of the year, although February was lower. Now, when you take this out to a longer term view, here's 5 years, and in fact, here's 10 years, you can see a much different picture. And when you take a look at the 5-year chart, actually in the middle of the range. So bond market volatility has not come down the way equity market volatility has. And I'll just show you the VIX again over the same time period so you can see the difference. The difference matters because bond market volatility is what has been spooking equities this year and last year mainly. And it's representative of what the Federal Reserve is doing. All of this put together means enhanced focus on what the Fed is doing, and bond market volatility can lead to equities market volatility, but we're not seeing that yet. That's just a little caveat that I'm throwing that out there. In the meantime, enjoy the bullishness.
There we go.
And enjoy your segments, Jared.
Thank you.
That's great.
Thank you.
That's great stuff.
That is great stuff. Very informative.
Thanks so much, Jared. All right, the Fed's rate hikes continue to ripple through the housing market, even if bulled-up investors in stocks don't care to pay attention. We just saw lackluster housing starts figures for June. The question now is what's next in housing? National Association of Home Builders CEO Jim Tobin perhaps has that answer for us. Jim, good to see you here. Let me frame it to you this way. You have RH, Home Furnishings Company, that CEO, Gary Friedman's painting the housing market as completely falling apart. But if you look at the permits component of the housing start today, signs of life. Where should, or should I say, who should investors believe?
Well, I think what we look at the way housing starts came out today, if we take out the May numbers, which we believe seem to be abnormally high, and maybe that's a little bit more of an aberration now. What the June numbers show us is that we're actually back on trend. In fact, even with this dip, we're still looking at the largest number of housing starts since June of last year. So the demand continues to be out there. But when we look a little bit forward ourselves, we are seeing interest rates are starting to wear on home buyers out there. Permits give us a little bit of a breathing room in the future. But right now, it seems that while demand is there, very few people are able to meet those or match those 7% interest rates.
Jim, should home buyers, potential home buyers, or even those that are selling, should they almost be thinking as 7% or that 7% level as the new normal? Or do you think we will see maybe some downward movement here in rates between now and year end?
Yeah, we think that interest rates are going to settle downward over the next 6 months, without a doubt. We're clearly at the end or about to be at the end of the Fed's tightening phase. And that said, I don't see the Fed easing anytime soon. In fact, we predicted the Fed's going to hold steady for probably another year or so. So I think while interest rates should come down, or at least mortgage rates should come down over the course of the next 6 months, I still think that home buyers need to get used to 6% or even 5.5%. But gone are the days of our 3 or 4% mortgages.
Jim, what should millennials living with their parents right now be doing? You have some money saved, maybe $150,000, $200,000. Do you just bite the bullet, take out a mortgage at these rates, and finally get into a home and get out of your parents' basement?
Yeah, I'm pro home ownership, plain and simple. So for me, if you've got money saved out, you've got money for a down payment, go ahead and dip your toes in. You're going to find more new homes, brand new homes are for sale than existing homes. We are running into this phenomenon where a lot of the existing homeowners are in those 3 or 4% mortgage rates that I talked about, and they're reluctant to move out into those higher rates. But there are some new products out there, and I would encourage anybody who wants to dip their toe into home ownership and to get in now. If you can find a home that meets your need and you can qualify for it. But it's always a great time to buy, especially with the market where it is. I'm encouraged that it's time to buy.
Jim, when it comes to lot availability for these home builders who are looking to build homes, is that an issue yet? And I guess if it's not yet, is that something that could potentially be a massive challenge here?
Yeah, I think the challenge facing our builders now is finding land to develop. That's a big issue, which means local governments need to help. If we're going to solve the housing affordability crisis in this country, and the only way to truly do that is to build more housing, then we're looking for local governments to embrace the need for home ownership and to encourage home ownership and rental. By making sure that they're putting the policies in place to find more land, and then lending will begin to ease over the course of the next 6 months or so. So there's opportunities out there, but it's going to take everybody pulling on the home ownership wagon to move forward.
Jim, all I think investors have heard from home builders, among other things, the past 2 years, and that has continued into the first half of this year, is inflation in materials prices, lumber, metal, labor, you name it. Has inflation started to turn in the components that go into building a home?
It has definitely. Lumber reached its peak about 2 years ago. That's now consistently down, which is great to see. In a lot of ways, the building material supply pipeline is whack-a-mole. Some components are up higher than others, while others are down, and then they seem to reverse over the next several months. Give an example. Right now, electrical transformers and electrical components that power a home are the real drag on home construction and apartment construction right now. But I do think inflation is easing in the component space and will continue to do so. We know how much the Fed is watching all of that and all those inflationary numbers. But from a homeownership perspective, we're encouraged that things are trending in the right way.
Jim Tobin, always great to hear from you, CEO of National Association of Home Builders. Thanks.
Thank you.
Well, coming up, we've got you the closing bell on Wall Street. We're checking in on some of the latest market moves and the top trending tickers on Yahoo Finance. We'll be right back. And that's the closing bell on Wall Street. The Dow closing to the upside for the 8th trading day in a row. You look at the S&P adding about 0.33%. The Nasdaq barely closing in positive territory, just slightly above the flat line, but we'll take that as a win. This market check sponsored by Tasty Trade. Well, let's take a look at some of the individual movers of the trading session. And Saz, we got to start with Carvana, because Carvana riding higher after the company reached a deal with bondholders, reducing its debt by over $1.2 billion, eliminating over 83% of the company's 2025 and 2027 unsecured note maturities. This is a stock that has massively run up since the start of the year. In recent months, we're talking about gains of over 1,000% at the highs.
I've always had mixed emotions with Carvana. So I've bought 3 cars from Carvana. The customer experience,
really?
yes, it's pretty darn good. Once you get over that fear of like, wow, I've just signed all these papers using DocuSign and they're very scary, the thing actually works pretty good. But then raw numbers, this company is constantly being attacked by various news outfits. You have analysts questioning the model. Maybe this alleviates some of that bottom line pressure that they've been dealing with really since their inception. It certainly doesn't hurt, and that's why the stock is ripping higher. And we're looking at shares of Constellation Brands closing the day higher as the Corona and Modelo beer maker revealed a settlement with one of its top holders and noted activist investor Elliott Management. Elliott Senior Portfolio Manager Mark Steinberg and Portfolio Manager Michael Goldberg said in a statement, "We are among Constellation's largest investors because we believe the company's meaningful growth potential powered by its premier Mexican beer portfolio is not currently reflected in the company's stock price and represents a significant amount of value that can be created from here." Bottom line, you see this brand or this company, Constellation Brands, run by CEO Bill Newlands, friend of our programming, really not getting, I think, the love that it deserves. You know, they've had a lot of troubles with their wine business. Their beer business, Corona and Modelo, have been on fire. And most notably, and I have a story on this on the Yahoo Finance homepage now, that business, Corona Light, has picked up market share because of everything going on with Bud Light. So I see what Elliott's talking about here.
Yeah, exactly. And I think when analysts look at this name, even when they look at one of the competitors out there like a Molson Coors, who has been able to kind of chip away at that market share that Bud Light has lost within the beer category, whether or not those new customers, drinkers, are going to stick with their brands or if they're going to trade back to Bud Light. And it almost seems like the line of thinking here from analysts is that they think that a name like Constellation Brands is going to be able to hold on to those new customers because people don't seem to be going back to Bud Light at the rate that we had initially, or the street had initially expected here when we did see that.
And I want to publicly thank you, Shauna Smith, because you were the one that told me to put lime in my Bud. Lemon. And it's
Bud Light. If no
and
one
it's
has
good.
ever
I
tried that
encourage you
before.
to give it a try. Maybe we're looking at these awful results from Goldman.
That was my college drink. And I still, to this day, here and there, we'll try it. But it is the best. Bud Light with a lemon. All right, we also got to take a look at Goldman Sachs. The stock closing up just about 1% as the Wall Street giant saw profits plunge during the second quarter. The company also struggling with its core businesses of deal-making, trading, while taking nearly $1 billion in impairment charges on consumer and commercial real estate holdings. Despite all of that, stocks, we're still looking at gains of just about 1%. And like we heard from Mike Mayo, it was a kind of, seems like an almost buy the news type of mentality that's happening today because we did see a heck of a lot of selling heading into this report.
You're stuck with me for about another hour, Sean. I'm sorry.
I like it.
No, well, look, at everything that Mike Mayo said, really, the top analyst still in banking, he is the OG, he is the proving ground. So when Mike Mayo comes on Yahoo Finance and says, essentially, the clock is ticking on David Solomon, Mike Mayo knows everybody. And I think these results, while the stock is getting embraced, maybe they weren't as bad as some feared, the clock is ticking on David Solomon. And the question now, does he survive into 2024? Right now is when budgets and plans start to take effect for next year. Does he survive it?
Yeah, certainly. The pressure is on for him to really right that ship and do it quickly. Well, C3 AI has been on a tear in the public markets this year, up over 260% year to date. However, amid its massive climb, the company has faced criticism from short sellers as some analysts question the company's growth prospects. Here to shed light on all that and more, we have C3 AI Chairman and CEO Tom Siebel, joined by Yahoo Finance's Ali Garfinkel. Ali.
Tom, thank you so much for joining us, and thanks for the toss, Shauna. How are you, Tom?
Hi, Ali.
So I want to start with C3's performance in the public markets because it's been nothing short of astonishing. Does C3 really have the tools to support the kind of growth that the markets are expecting?
Well, I think that it's generally considered that the market for artificial intelligence is now AI software, exceeds the addressable market opportunity in software exceeds $1 trillion, according to Bloomberg and others. C3 AI is clearly one of the leaders in enterprise application software. So I think it has we're a large and successful company with many successful products addressing a huge addressable market. And I think that is what the market is reflecting.
And how big is that addressable market, Tom?
According to Bloomberg, just generative AI alone exceeds I think $1.2 billion. If we look at enterprise AI as it relates to writ large, that even without generative AI, the predictions are 5, 6, 700 billion dollar addressable market opportunity. So this is as big a market opportunity as I think we've seen in the history of enterprise application software.
Now, I want to talk a little bit about who C3's customers are. I know the customer count from the latest series of filings is about 287. However, that includes a lot of different definitions. I think trials are included, paid subscriptions, that sort of thing. And you've changed the definition of a customer at C3 before. I guess my question is, why? Why is it so hard to pin down a customer?
Well, the nature of the customer has changed, Allie. We've been in business for 14 years. And we've moved, originally we did business with large utilities and then energy companies and then manufacturing companies. And, now we have basically consumer products where we have, OEM distributors. And so as it's a very, very complex fabric of customers that we have out there in the energy industry, the defense industry, the consumer packaged goods industry, the food industries, individual data scientists, individual end users that might sign up and use our products for $25 a piece. So as the company has evolved over the last 14 years, the customer mix has changed, very significantly, has expanded very significantly, and we've continued to, do our best to provide the market, as accurate as we can, a representation of the number of customers that we have.
And do you feel like customer growth has been happening fast enough, Tom?
I think that last year it went from something like 128 to 287 or something. So it looks like a pretty good growth clip to me. I think it's quite rapid.
Now, I want to also ask you about CFO turnover at C3. I know, for instance, when I was sort of looking through files, I found that there have been about 9 CFOs, I believe, in the 14-year history of C3. Does that sound about right to you?
It could be. It sounds plausible.
Mm-hmm. Yeah. Does that turnover make sense? How do you explain that kind of turnover? Because some of the statistics I've found suggest that's not exactly standard.
Well, I think if you look at many technology companies out there, Oracle, Tesla, Twitter, Stripe, others have had many chief financial officers. C3 has been around for now 14 years. We started with 3 people. We went to 10 people. We went to 100 people. And we went from a U.S. company to a multinational company. And I can assure you, it's a different type of CFO that you need to run a 5-person company than you need to run a 1,000-person global company. So I think as the company has evolved, it's had appropriate executives to fulfill those roles. We have a highly experienced executive in that role today, and many companies have changed CFOs over the year. Oracle, Tesla, Twitter, and so has C3.
And then the last question, Tom: the short sellers who are in C3 right now, what's your message to them?
I'm not sure who you might be referring to. I think that any investor that's taking a short thesis, a short on the AI thesis writ large in 22 and 23 is like really a crummy investor. I mean, this is like betting against the internet in 1996. I mean, how stupid can you be? So it's I think they're getting killed financially. And they're just bad investors.
Betting against the internet in 1996, you said?
That would be a pretty bad bet, right?
It certainly would be. Thank you so much for your time, Tom. And back to you, Shauna and Brian in the studio.
All right, Ali Garfinkel, thanks so much for bringing us that conversation. We want to get over to Netflix earnings just crossing the wires right now and taking a look at how shares are trading after hours, off just about 3%. The big reason why we're seeing some pressure on this stock has to do with the forecast. The third quarter sales forecast lagging the street's estimates. Netflix seeing revenue of $8.5 billion. The estimate from the street was for $8.67 billion. But when it comes to the second quarter, the standout number for me is the paid streamer ads, as subscribers that they added during the quarter, 5.9 million in the second quarter, blowing past the street's expectations of just over 2 million, really showing that the crackdown on password sharing, offering a huge boost here for Netflix for its subscriber numbers. For the sales numbers for the second quarter, that came in at a slight miss, 8.19 billion. Estimate on the street was for 8.29 billion. When it comes to EPS, that was a big beat here from Netflix. But Saz, my two takeaways is that forecast. That's why we're seeing the pressure on the stock here after hours. But the subscriber beat, and by the magnitude of that subscriber beat, it's certainly something to be a little bit encouraged about.
I'm going to take the other side of it. I guess I understand. I mean, I'm actually on your side. I get the market's reaction. When I'm looking at operating profit margin up year over year, 22.3 versus 19.8, instantly tells me their issue or their focus on wringing more profits out of their subscriber base is working. To your point, those net adds at 5.8 million, that is a huge number, telling, at least for me, that people are willing to pay and pay more to use Netflix. That was a concern, I think, coming into this Netflix quarter. Are people willing to pay and pay more to stay on the service? And last but not least, along those lines, 6% increase in the average paid membership. That is, I think, checks a lot of boxes on what has driven Netflix shares up year date.
Yeah, we know a lot of that focus was on the average revenue per user and how big of a jump we would see given the fact that more people are spending here for the streaming service. Also, another thing in this note that's jumping out to me here is what Netflix said. While we continue to grow our reach, ads plan membership has nearly doubled since the first quarter, but it's off that small membership base. So they do see ad revenue helping Netflix, although saying that won't be material here for Netflix for at least some time.
Quick bonus takeaway, this quarter, that big beat on net ads, not good for Disney's streaming ambitions. That's why I read that as well.
All right, well there, you've heard it here first. All right, well let's get over to Josh Shaver with a closer look at how we're trading today and how we've traded over the last couple of years.
I wanted to take a little bit of a historical look there here and get into maybe a little bit of a discussion about a buy the rumor, sell the news that we might be seeing in terms of Netflix, because a lot of those headlines you guys were mentioning, I think overall maybe are good for the long-term investor story in Netflix. What I have right now is the 3-year. You can see how far beaten down Netflix was in 2022. It's been one of those stocks that we've seen rally in 2023, and I want to just take a little bit of a walkthrough of what we saw leading up to this earnings call. You remember CEO Reed Hastings out in early January. You saw a big jump there. Then you saw some of the rumors start to come out at the end of March, right? This is that the ad tier was going well for Netflix. You saw a big jump back in March on that. Then you fast forward to May and you start hearing more about that password crackdown. You hear the password crackdown starts going well. You also have that big rally that we've seen overall in tech. Netflix certainly caught up in that. Also, most recently, as we've seen this here, Netflix is considered to be maybe a winner if the Hollywood strike is to continue. Netflix has been picked up here. They have a lot of exposure to broad markets, to European markets, to Asian markets where they create movies. So maybe they'll benefit from an extended Hollywood strike with those actors and writers. So Netflix has been on quite a run this year, guys, up almost 62%. And I'm wondering if that's part of the reason maybe you're seeing a little bit of down action today. Certainly some profits to be taken, and something that I think we should be watching when we think overall about tech earnings this quarter. A lot of these companies have done very well to start the year. How do investors react to that when you think about maybe even a company like Tesla or some of these other companies that have seen stocks go up over 100% to start the year? How do investors react when they take in these earnings?
Hey, glad you mentioned Tesla. Josh Shaver, good analysis. We appreciate it. Let's get on these Tesla earnings. So earnings beating estimates, Shauna, here by 10 cents, but the market could absolutely care less. You're seeing a little bit of a reversal. Shares in Tesla now trading lower on these numbers. Why? We talked about it coming into this report, and it's good to see investors focusing on this. This is gross profit margin, 18.2%, missing consensus forecast of 18.8%. And then, guess what? Down almost 700 bips or basis points year over year. And the market is not liking that. Why? Because it tells you these price cuts that Tesla has led in the marketplace with has put pressure on Ford and GM to follow suit. These price cuts are weighing on Tesla's profit margins, and the street might be too high in its earnings estimates for the balance of this year and probably 2024. And hey, who knows, Shauna, maybe 2025.
And so the pressure was on Tesla headed into these results because of the massive run-up that we've seen in shares since the start of the year. We're talking a gain just about 140% since January 1st. The pressure on margins, that was the number one thing to watch. We heard from Tesla's CFO at the start of this year talking about that 20% goal here for gross margins. Once again, Tesla below that at 18.2%, a bigger drop than the street was expecting to see. That could be a massive headwind here for Tesla, at least in the short term. And those pricing wars doesn't seem to be letting up anytime soon. Earlier this week, Ford cutting the price of its Lightning electric pickup truck here, adding to some of that competition that we are seeing here within the EV space. Tesla coming out with its Cybertruck, producing its first Cybertruck over the weekend. You got to think that maybe we will see more price cuts here in the future, given the fact that they need to do something to increase demand.
Right on, and far be it from me to instantly poo-poo this quarter from Tesla before its earnings call. But when you're going through this earnings release from Tesla, scroll down to the profitability explanation. You'll see on the third bullet point, increase in operating expenses driven by Cybertruck, AI, and other large projects. I think investors have totally forgot to make money in the future, you need to invest money today. And I think you're now starting to see some of these investments. The Cybertruck is not free to produce. Creating AI tools, not free to produce, is going to weigh on Tesla's profit margins as it's lowering prices. To me, that's not a great combination. But what do I know?
When you take a look again, though, at the headline numbers, despite that operating margin miss here, revenue $24.9 billion coming in ahead of the street's expectations. Also a beat there on EPS, adjusted EPS 91 cents. The street was looking for EPS of 81 cents. All right, coming up, we're going to dig deeper into these reports. We'll get analyst reaction to Netflix and Tesla. We got that for you right after the break.
Let's do a check in the markets here, sponsored by Tasty Trade. We saw the Dow, S&P 500, Nasdaq all finish in the green. I will note, though, a couple movers here. You had Carvana finish the session up 40% on its debt restructuring deal. Shares down about 2% after hours. And of course, Sean, we're still watching Tesla. That share is a volatile trading here in the aftermarket. Earnings beat from them, gross margin miss. And Netflix, really, I think, surprising a lot of folks, seeing volatile trading there as well.
So let's take a look at IBM. Shares are pretty much flat here in extended trading, but the company just releasing their quarterly numbers and digging into it. A solid report when it comes to EPS. That was a big beat, $2.18 on an adjusted basis. The street was looking for at $2.01. Revenue essentially in line with expectations, right around $15.5 billion. They maintained their full year sales forecast for the year. But we were on the phone with IBM's CFO, Jim Cavanaugh, earlier today, talking to him about what the current landscape looks like and what he's hearing from clients in terms of the back half of the year and looking ahead to 2024.
Jim Cavanaugh, really one of the most respected CFOs in the CFO game, I should say. And, you know, Sean, when he tells us, I'm really not seeing that much of a slowdown. Actually, I believe he said he's seeing an acceleration into the back half of the year. Didn't really share some of the economic concerns we have heard from other top leaders. But we also put to him a real interesting question on artificial intelligence. You know, you go to our platform, you see that P multiple for IBM about 15 times. You look at Salesforce over 30, Microsoft about 33 times forward earnings, and IBM's doing artificial intelligence. You know, we asked Jim, what more do you have to do to get this story out? He said, really just consistent execution, but they might have to do more than that. Yeah,
consistent execution, that at least is what Jim is saying is their strategy from this point. They're focusing on, and Jim made this point in terms of what they're doing with AI and how that is different from what we're seeing from some of the other players out there. They're focusing on corporations, on the business aspect of it. They just rolled out that new platform earlier this year. Watson X, I believe, is the name of that. So it's just getting started, saying that they're still in the early stages of that and the early starts of monetization. He expecting to see that within the consulting practice, but certainly not adding much to results just yet. In extended hours, we're looking at a flat stock as of right now.
All right, we'll take it. All right, let's get back to one of the reports of the evening. That's Netflix. Netflix managed to beat inflated estimates across the board in the second quarter. Let's dive into whether the already hot stock will run further. Jamie Lumley covers the media space for Third Bridge. Jamie, good to see you here. Two different ways to look at this quarter, I suspect. Third quarter guidance, a little squishy, but the quarter itself, I think, blew some minds. What's your take on the results?
So I think there are a couple of things to look at here. And the first number that I believe most people look towards when the earnings came out is, of course, what's going on with subscriber growth. To start off this year, the two big questions were what is going to happen with the ongoing rollout of the ad tier? And then also, can Netflix pull it off when it comes to launching its crackdown on password sharing and then having those paid shared accounts? And based off of these numbers, with 5.9 million subscriber ads, it does seem that they're building momentum in both initiatives. And that's definitely important because when it comes to underlying profitability, each incremental user from those shared accounts is directly contributing to that bottom line and can definitely create substantial opportunity for the company. And also just looking at the potential of this move, one thing that we've been hearing from experts is of the potential 100 million households that Netflix believed were sharing passwords before this initiative began, up to half of those could probably be ultimately converted to paid customers, which would represent significant growth for the company. And it does seem that they are moving in the right direction to start to capture some of that growth.
Jamie, how much of this, though, has already been priced into the stock? Because we're looking at shares under pressure after hours. Yes, their guidance came up just a bit light, but we've already seen so much of this optimism, it seems like, already baked in.
So if we think about where Netflix is going from here as a company, while it does seem to be seeing some progress, some momentum in a couple of these different areas, the future has its fair share of challenges. I think on the one hand, competition remains hot. There are so many players out here all trying to scoop up share as they work on scaling their streaming platforms. And there's also the degree of uncertainty around what exactly will the impact be of the dual strike in Hollywood. As of right now, pipelines are frozen. While there may be about a year's worth of material that Netflix is going to be able to release, that is the lifeblood of a streaming platform's success. And an ongoing concern about that can definitely have some consequences down the road, particularly as the velocity of content being released on platforms start to slow. From what we've heard, based off of what the experts we speak to say, Netflix is in the pole position in its ability to ride out this strike. But at the same time, if they start to see, or users start to see content not released as quickly, they might start to cancel their subscriptions, which could present certainly a large headwind down the road.
Jamie, it sounds like no catalyst ahead, at least from a positive standpoint for Netflix.
Well, if we're looking at catalysts, certainly we're in early days of the crackdown on password sharing. If we look at the launch in the US, that was only in May. We are only a bit more than a month or two into that. So there's substantial opportunity to capture some of that share in some of those users which were not previously paying. Also at the same time, just circling back to the relative positioning of these different players, if we're looking at the impact of the writer's strike, in addition to Netflix have a decent amount of pipeline, it has that international footprint. It has that international production capabilities that not all of its competitors have. If we're looking over at a Paramount or a Lionsgate, for example. So there are definitely some areas where Netflix can feel pretty good about its ability to manage some of these challenges down the road. But it is worth understanding that it still remains competitive. There still remains a number of pressures in this industry and a degree of uncertainty to consider as well.
Jamie, what do you think is going to be the fallout, or maybe what's going to happen here to Netflix's business, given the fact that it is getting rid of its lowest price ad-free plan? Is that going to be, where do you see those users going? How many of those do you expect to upgrade to that higher price plan versus dropping down to that ad-supported tier?
It's a really good question, and this is one of the interesting questions for Netflix because ultimately it comes down to, of course, how much are users willing to deal with ads and how much are they willing to pay not to have that. What's interesting from Netflix's standpoint, and this is what we've been hearing from our experts, is that for them, for a while, it has been much better for Netflix to have users on that ad-supported tier because in addition to the basic fee of $7 a month, they can generate upwards of $5 to $6 in ad revenue on top of that, which would make it overall a larger revenue contributor than that basic plan which Netflix just canceled. So by and large, for them, if users do navigate towards that ad-supported tier, that could be a windfall in terms of generating increased revenues per user. But at the same time, certainly, I'm sure Netflix will be happy to see people get into those more higher price plans, which can definitely contribute to stronger ARPUs as a whole.
And Jamie, so we have really some better than expected paid additions from Netflix. That's good for Netflix, but is that bad news? And I'm just looking at some of the competitors here. Paramount, you have Disney Plus, and you have Hulu. Are we looking at a really disastrous earnings season from all the streamers not named Netflix?
So one of the big things to keep in mind for those other streamers, the fact that, of course, for them, in addition to trying to scale their platforms, try to make the economics work for that part of the business, they still are trying to support the legacy linear distribution model, be that through box office results or cable or the fall movie lineups. And for them, we might really start to see some pressure, which was already mounting over recent quarters, on top of that, then having the disruption of the dual strike out in Hollywood. What we've been hearing from our experts is that basically the fall lineups are already considered a wash. So a player like a Warner Brothers Discovery, a Paramount, a Disney will really start to feel some pressure on that portion of their business. And then on top of that, still facing the competitive pressure when it comes to their streaming offerings. So there's definitely a lot to be seen as we get those earnings results and get a sense check for where these different companies are. But it's looking at those which are still straddling the line here with the traditional linear distribution and the streaming platform, they do have an added amount of challenges which they're trying to navigate.
Jamie Lumley from Third top analysis for us on a busy day. Thanks so much.
Thank you.
Coming up, Tesla earnings are driving the stock price after hours. We'll break down the numbers on the other side. We're seeing Tesla shares really all over the map. Right now, they're green. Tesla rocked investors with a mixed quarter at best. Gross margins missed estimates as price cuts took their toll. Let's get you set up for the next trade. Craig Irwin of Roth Capital joins us now. Craig, good to see you here today. Stock is all over the map. Right now, Tesla shares are higher. We were calling out the negative in this report, notably that gross margin whiff. But what is good in this report, and why would the stock be higher?
So a lot of people were looking at auto gross margins, right? Not the headline gross margin. Auto gross margins about 17.5%. We're in line with what a lot of the buy side was expecting. So the real question is, are we in a trough, right? I obviously don't believe that. I expect more price cuts ahead, and I think that the price elasticity we saw was actually quite sloppy. But the margins on an adjusted basis, auto gross margins coming in essentially in line, would be taken as a positive. And the release didn't really have much in the way of discussion of further price cuts. We did see Ford lead with Lightning Pro price cut of 10 grand just this past week ahead of the Cybertruck official launch. So Tesla's been playing this game. Others are going to play it too. Let's be careful on that. I think that's a key part of the discussion on this call is going to be price elasticity and price cuts.
Craig, well, a lot of people are also looking at how this is affecting demand, right? With lower prices, you would think that would be a big boost to demand. But when you take a look at these global inventory numbers here, 16 days, that's up from 15. Not a huge jump, but does this signal maybe that we are starting to see lower than expected demand for Teslas?
Well, absolutely. I mean, you look at the fourth quarter to second quarter comp. I mean, you had roughly 15% price cuts, and it grew volume just 15%. That is tepid at best. I think Tesla's dominated the market. They've done a phenomenal job, but competition's real. The environment is difficult. And they do acknowledge that in their release that this is a good quarter for them, considering the environment. And that's why I believe we're not seeing a more robust guide into the end of the year. They're still at that 1.8 million units, which means they are being a little bit careful, a little bit conservative right here.
Craig, you think the market is just too optimistic on Tesla? From the standpoint, yes, we all know they're lowering prices, but as we talked about when these numbers broke, they're investing a ton of money in AI and Cybertruck. Now, these things might pay off longer term, but they cost a lot of money today. Do you think Tesla's set up for some earnings misses in the back half of this year because of this aggressive spending?
Well, I don't necessarily think the spending is a bad idea, right? This is a technology company that is playing very efficiently, very effectively in the automotive market. I think where the misses are likely to come from, the reason that I'm very bearish versus my peers, is I think that competition is real. I think that people are much better off investing in other names in the space. I think that you're going to see some very successful vehicle launches from other OEMs, and you're going to see continued traction with some of these other vehicles. And that means that Tesla will lose share. They'll face pricing pressure, and that margins will continue to be under pressure. And that fundamentally is not a good setup. And things aren't going to get better in 24 than they are in 23. So we're very bearish on Tesla right here. We see it as egregiously overvalued. We think people are much better off just looking at many of the other names, either conventional auto OEMs or some of the emerging players, as opportunities for investment.
Craig, how overvalued? Is this just a $100, $150 stock?
I have an $85 price target.
$85?
Yes. If this stock was to trade in that range, it would be valued somewhere near Toyota. And Toyota has, 5x the number of vehicles roughly that they'll sell this year. Tesla does not have any technology that Toyota does not. Toyota is just a conservative company that delivers and delivers quality. Tesla, you look at the Cybertruck, their photograph shows mismatches on the door. They haven't come through with the wipers technology that they came. It's not an exoskeleton vehicle. I mean, Tesla's fallen short on that so many times, so many ways. Okay, this is not the commercial first vehicle, but there's obviously fit and finish problems. Toyota doesn't play like that. This has got a lot to learn.
Craig, $85. Just given where the results came in, do you think you'll take it down to $50, $60? I mean, do you have to make revisions?
So I'm always reevaluating my target, my thesis, right? And the one thing that would have me maybe make a more substantial change to my thesis is the work that they're doing around modular assembly. So this whole thing for the launch of the mini car, where they're looking to take out substantial cost in assembly, that's essential for preserving margins. It would be transformational for the industry. I've been bearish on that, kind of a naysayer, but some of the auto executives are saying don't count them out. So I'm diligencing that. I don't see anything in this report yet that would have me dramatically change my opinion. I still think Tesla is egregiously overvalued right here.
Craig, I'm scared to look at my Twitter feed and see what all the Tesla bulls are looking at right now. But hey, you know what? We appreciate you sticking with your call and doing some deep dive analysis. Craig Erman, thanks so much. Good luck on that earnings call.
Thank you.
All right, coming up, we're going around the horn and checking in on some of the top trending stories of the day. Ali Canal and Josh Schaefer are standing by. What you got for us, guys?
Hey, Josh, I got my laptop. Sorry, Sazi. I'm with Josh. I have my laptop here. We're breaking down Netflix earnings. We have pros coming on soon for Tesla. There's a lot to dig into with these earnings.
Tons of numbers to get through, and I got one metric I'm watching on Netflix. We'll get into that next.
Warner Brothers' Barbie has fans buzzing, but it's much more than just a movie to Mattel. The company is betting big on Hollywood, with several movies based on its toys already announced. Here are some of the top films in the works. Polly Pocket. Lena Dunham is planning to write and direct, while Lily Collins is set to star as the famous Micro Doll. Hot Wheels. J.J. Abrams' company Bad Robot will reportedly produce the film based on Mattel's toy car brand. Thomas the Tank Engine. Set to be directed by Quantum of Solace director Mark Forster, the movie will be a mix of live action and animation. Rock'em Sock'em Robots. Vin Diesel is set to star in a live-action movie based on Mattel's two-player action toy. And Viewmaster. MGM and Mattel are reportedly teaming up to produce a live-action movie about the stereoscope toy. If Barbie or any of the Mattel films want to be the queen of the box office, they'll have to take down Hasbro's Transformers, the highest-grossing movie series based on a toy franchise.
Welcome back to Yahoo Finance. Josh Schaefer here with Alexandra Canal and Pras Subramanian. We're going to be talking Netflix earnings, Tesla earnings. I want to start first with Netflix earnings. We got Netflix shares down a little bit after hours here. Allie, what is the main takeaway that you're seeing right now driving shares down?
Yeah, main takeaway is they guided Q3 revenue lower than expected. They said Q3 revenue would come in at $8.52 billion. That's below expectations of $8.67 billion. And it comes after revenue also missed estimates in the quarter. But you're seeing earnings per share, a significant beat there. I also want to call out a few other notable beats here in terms of profitability. We had operating margin and free cash flow steadily beat those expectations. Operating margin hitting 22.3% in the quarter. That's well ahead of Netflix's own projection of 19%. Also, free cash flow, the expectation there was $542 million. It came in at $1.34 billion, and Netflix also raised its full-year outlook for free cash flow to $5 billion on the heels of that double writer strike, which we have been hearing from analysts. So interesting that the strike is not hurting Netflix. In fact, it's boosting Netflix
also
a little bit.
Interesting in the overall context of the streaming conversation we keep having, and we keep talking about profitability, right? And how these companies need to be profitable, and now the only streaming company that is profitable just showed a lot of metrics about being more profitable and increasing in that sign, and now they're getting hit because the top line isn't doing well. At some point, what is it? To some extent, it seems like a little bit.
And look, I mean, the expectations were so high heading into this report. There was a ton of bullish sentiment. We kept getting analyst upgrades. We kept getting price target boosts. I was a little surprised to see that we didn't have a double beat just because of how many notes I read that said they would significantly beat on all of these metrics. And now that we got one that missed expectations, investors are punishing the company, so to speak.
Yeah, maybe a case of too high expectations going into this report. I was surprised to see that strong subscriber growth numbers. I guess we've seen the password stuff kind of feeling that bite there on a positive trend for Netflix. Also funny, interesting to note that that writer strike stuff. Is it because they're not going to be paying out some of these fees that they're increasing that limit there? Is that part of the reason why?
Yeah, that's part of it. Just not having to spend so much on content because there's no content to be created to buy with the actors on strike, and the writers also on strike. You mentioned subscribers, 5.89 million net additions. The expectation there was for roughly 2 million. So huge jump there. And if you remember about a year ago, we lost 1 million subscribers. So for Netflix, this I think is really good momentum heading into the back half of this year. I'm very curious to see what executives are going to say on the call, right? Especially in regards to the strike, because I do think we get a lot of context and a lot more color on the call to these numbers. And I think that could potentially change the share price.
Yeah, and just Josh, talking about profitability, it's a pretty profitable business. I mean, over 20% operating margins, that's great. You would be very happy to have that. But maybe there's this whole sell the news a bit here after a nice run up. I think that's part of it.
That's what I was going to say. I mean, I think that's going to be a story of this earnings season. When you think about a lot of what's been caught up in this rally, right? And Netflix has had a good year. I'm not saying that they got caught up in the AI rally and that's why it's up 70%, but the stock's up 70%. At some point, stocks don't just go up forever on good metrics. Those metrics were already sort of priced into the stock. You're seeing it teeter a little bit now before the call, and then you see what it does over the next 6 months, right? You're not necessarily always going to have these big beats, big jumps like we saw in the first quarter when it came to some of those companies when they talked about AI or when Netflix has had these bonuses from talking about the ad growth and things like that in the past. I think you're sort of seeing a little bit more muted because it's already priced into the stock to some extent.
Yes, and Josh, I think you wrote about this too, that the theme of this earnings season as well will be unless these companies significantly beat, you're not going to see much change in the stock price because we do have an overheated market right now.
And let's talk about another stock, Ross, that's been a little hot. We got Tesla up over 100% to start the year. Now on earnings, really not moving too much. I mean, what was the main takeaway?
So first of all, I want to say in relation to also Netflix too, is that we're talking about after hours trading here. So it's very light. It's very sort of volatile. Wait till tomorrow to see what's going to happen. But right now, Tesla shares basically flat, which is kind of a surprise for Tesla. But I want to note that strong earnings, revenue beat here, revenue up to almost $25 billion, right? That's up 46% from a year ago, so strong revenue there. But what's causing it? It's those price cuts, fueling those additional sales. So a margin miss here, 18.2% margins, missing estimates there. Operating margins came in at 9.6%, Allie, compare that to Netflix, right?
Right.
And that's the first time it's dipped below 10 in a long time, almost 500 basis points lower than a year ago. So really seeing that margin issue here. Hopefully we hear for Tesla investors, hopefully you hear about, hey, this is the trough of our margin kind of season here. Hopefully they're going to pick up slightly. We'll see what they say, but they didn't indicate that this is the end of margin sort of
that
slippage.
To me is part of probably why you're seeing Tesla stock not move that much right now, right? Because they don't put out guidance for that margin in that release you were just going through. So you don't really have any insight into if it is trough. A lot of analysts have called for it to be the bottom of that margin decline that we've seen over the last couple of quarters. Until you actually know, until Elon comes on tonight and hopefully for Tesla investors says this is as low as the margin's going to get, we think we're going to get back up now.
Yeah.
Then you probably see the stock pop, or at least that's what people are looking for, right? Also, another interesting part of what you were reading that I thought is just stands out about Tesla and how it normally moves after earnings. So Tesla's beat on adjusted EPS 8 of the last 10 quarters. The stock's fallen 6 of those times, though. And that's normally a metric that sometimes you move up on, right? So it hasn't necessarily been a driver for Tesla to the upside, even when they do beat.
It's never been about the earnings, right? It's been about the other stuff, the margins, the cyber.
Well,
What's he saying about the
Netflix
Cybertruck?
too. Netflix too. I mean, earnings steadily beat, but that's not enough. The stock's down 5%.
So, yeah, Cybertruck on track for production and also initial deliveries later this year is what they said. So we'll see if that means Q3 or Q4. Elon Musk said last quarter, Q3, end of Q3 was the delivery event slated to be scheduled. We'll see if that happens. So we'll hear about that in a little bit.
So what do you think the margin decline and the margin miss was on? Was it from those price hikes and the pricing war that we're seeing?
The price cuts, for sure.
Price cuts, yes.
Yeah, they haven't been able to sort of improve scale and potentially component pricing enough to overcompensate for those price cuts. Maybe we'll hear a bit more about in the call, like, hey, actually, you know what, we're seeing that improve. We're actually build more cars cheaper. Parts are cheaper. We're going to actually kind of start seeing the higher profit margins here despite low prices. So that's the kind of goal that I think people want to hear about.
Interesting that the price cuts could boost revenue, but then hurt margins
totally.
in that way. Well, there's a lot more to digest from these earnings reports. We got more for you coming up on the other side of this break. Stay tuned.
Let's take a look at a couple of names trending after hours. United, Las Vegas Sands, Netflix, and Tesla we've got on our board here. Let's kick it off with United, the only stock, well, I guess Tesla's now in the green too, but United posting the biggest gain that we're seeing here in extended trading among this group, up nearly 3%. Solid report here from the airliner. They raised their full year outlook. They cited strong fares, solid demand, also this pent-up demand for international travel. That's been a big boost to results here as of late. United also saying that they expect their planes to remain full following the very important summer travel season. Adjusted profit for the quarter, $5.03. That was a big beat. Revenue rising to $14.18 billion. We're looking at a gain for United of just about 18% over the last 3 months. Year to date, it's up about 45%. Certainly the airliners among the outperformers as consumers continue to spend on experiences, and this group benefiting. Let's take a look at Las Vegas Sands. That's under a bit of pressure here, but the results for the quarter, it actually wasn't that bad. Taking a look at these numbers, the company actually swinging to a profit, beating expectations. Sales coming in at $2.54 billion. The company also reinstating its dividend. They had suspended their dividend at the start of COVID, but this is a stock that's already up about 24% year to date. Over the last year, looking at a gain of just about 67%. So a lot of this optimism perhaps already priced in. Let's take a look at Netflix, another mover here in extended trading. When it comes to why we're looking at losses of about 4%, it all comes down to guidance. Its third quarter sales forecast coming in just a bit short. For the quarter, though, the numbers were pretty strong, especially when it comes to net adds here, subscriber numbers. Look at the company adding 5.89 million subscribers. That was nearly triple the street's estimates here. The company also making some comments here in regards to the strike, saying that they expect the strike to lower costs by about $1.5 billion this year because they're spending less on content. And rounding it out real quick with Tesla, the stock up just about 0.5% in extended trading. A miss here on margins. That's going to be a key in this earnings call, but they did beat on the top and bottom lines. Over the last 3 months, we're looking at gains of about 61%, Sauce.
Shauna Smith getting all the fun tickers. I want to talk United. Shares are just soaring higher. All right, well, needless to say, it's closing time here at Yahoo Finance Live. Here's a look at some of the top stories of the day. Carvana shares soaring on the day. The company reaching a deal to reduce its debt by $1.2 billion. In a separate announcement, Carvana also saying it will sell up to $1 billion in shares as it looks to raise capital and restructure operations. Apple is reportedly joining the AI battle. Bloomberg reporting the tech giant is working on its own large language models that would rival ChatGPT and OpenAI, but the company doesn't have a full strategy quite yet. And UPS and the Teamsters Union are heading back to the negotiating table, both sides issuing statements on Wednesday that talks will resume next week, and it comes as the clock ticks down to the August 1st deadline. UPS saying it's ready to increase pay, but emphasize that a deal needs to get finalized quickly. Any disruption in UPS service could have serious economic effects. One group estimating a 10-day strike could cost $7 billion. Now here's what to watch for Thursday. More earnings on deck ahead of the opening bell. We'll hear from American Airlines, its report following strong results from United and Delta, thanks to soaring consumer demand. And we'll be watching results from two Dow components, insurance company Travelers, along with Johnson & Johnson, both set to report second quarter results. And also more economic data on tap. Very busy day, as you can see. We've got jobless claims estimates set for 240,000. This coming after jobless claims dipped to 237,000 in the week ending July 8th. Meanwhile, for housing, existing home sales data is on deck for the month of June. Supplies of existing homes have been tight, leading to strength in newly constructed homes. We'll have to see if the trend will continue. This all while rates continue to be a key focus by investors and those wanting to buy a house. Freddie Mac will be out with its new reading on mortgage rates. Last report revealed rates rising to their highest level since November 2022, as increases in housing costs remain stubbornly high. Wow. That's a lot. Very, very, very busy day. And you know what, Shona, you'll be here to cover it, and I'll be back to my new day job. That's it for us. I'll be back here at 9 a.m. Eastern Standard Time on Yahoo Finance Live. Do tune in, and we'll know.
Come back, Faz. Come back soon.
All right, maybe.